Welcome to The Path to Exit, a podcast to help software and internet founders understand the process to raise capital or sell their business.
Hello and welcome, everyone. I'm Mike Lyon, founder and managing director at Vista Point Advisors, and this is The Path to Exit. This show is dedicated to helping founders of software and internet businesses understand what it takes to raise capital or sell their business and how to do it well. My guest today is Lacey, managing director at Vista Point Advisors. Miles and I have worked together for over a decade advising founders throughout the transaction process. In today's episode, we will discuss key considerations and what you need to have in place before launching a sales process. Miles, thanks for joining us.
Happy to be here.
Selling your company can be really stressful, but one way to knock down that stress level is to get really organized up front. This will allow the process to go more smoothly. You'll probably end up having a more competitive process and get a better price. But today we're going to walk you through some of the key things you should have in place before you even think about starting a sales process. Miles, let's start with tax and estate planning. Talk us through at a high level, what are the things you need to have in place and think about before you even begin talking to buyers?
I think tax and estate planning is probably one of the things that is the longest lead time in general. And so there's a number of things you could do or should be considering. So for example, utilizing different financial vehicles like gifting stock, different trusts, charitable donations, all these different strategies that can ultimately help you minimize your tax burden are super important to making sure that you do that well in advance of considering to sell the business and just having that aligned. Another good example of that is QSBS, or qualified small business stock. That generally has a number of years before you qualify for that. And so making sure that your company's organized in the right way and that you, in fact, do qualify well in advance of looking at a transaction is something that has, once again, just a really long lead time. And all too often, we see founders wait until the last minute to really consider some of these things, but it would definitely behoove them to do so years in advance.
Another item I'd throw in there, and this is a really long lead time item, a lot of software businesses tend to start in what I would call high tax geos. So think state taxes, so think California, New York. Sometimes founders will think about relocating their business well in advance of the sale process and frankly to help minimize some of those state taxes. So this is one of the ones where I think you have to think really far in advance. There are a lot of options to help you minimize tax. And the way I would think about this is if you're selling your business, there's the purchase price you get for the business, which generally you want to optimize and make the highest. Also, the taxes can have a big impact on your actual take-home post-tax. There's a lot of things you can do here, but early planning is important. And it may even change things like where you domicile the business, where you live, how you think about doling out equity to employees. So I think this is one you want to get educated on early. The good news is there's lots of advisors out there who are willing to put in a lot of time to help you understand this. Obviously, they want to help you manage your money post-transaction sale. And we have a great podcast on this topic specifically around minimizing tax. But I agree with Miles. This is one you want to start pretty far in advance. Make sure you have a good handle on it and don't wait till the very end. There can be real hard dollar costs if you wait till the end to think about that. Anything else you want to add there, Miles?
No, I think that's it.
Okay, I think the second item we wanted to talk about is this concept of succession planning. And really what's looped into this is what do you want to do post-transaction? Are you going to stick around and run the business? Do you want to ride off into the sunset? So Miles, maybe talk about why this should be done early and some of the key considerations for a founder when they're considering succession planning.
So all buyers and investors are highly focused on succession planning and ultimately which employees will be coming over as part of the transaction post-deal. And as a founder, oftentimes what ends up happening is you founded the business, you've been operating it day to day for years and years, often in the role as CEO or president. And when the transaction ultimately closes, buyers and investors get really nervous about the idea of you leaving or walking away. And so one of the strategies that founders can do to really mitigate that risk and that issue and give you more options post-transaction is to build out a really strong executive team around you. So think COO, CFO, CRO, maybe if you're the CEO, hiring someone that is a president, really sitting in that lieutenant role where you can hopefully pass off some of your day-to-day responsibilities gradually over the period of a couple of years. So that way, when you do go to exit the business, you're really positioned more so as a chairman and a founder that is somewhat stepped in the background, and that you've built a team that is entirely capable of running the business day to day. That just gives you far more options, far more flexibility regarding what you want to do post-transaction. And I think as buyers and investors look at the business, they just feel a lot better knowing there is a deep management team with systems in place. And it's not all reliant on the CEO and founder who's been there since day one and knows where all the bodies are buried, so to speak.
A couple other points I would highlight here is the biggest mistake I see founders make in this area is they'll have all the conversations with the buyer. They'll kind of position themselves as the most important employee, which obviously they are, being the founder. And what that does is that just puts you in a suboptimal position if you want to exit the business post-close. They're now worried about you leaving, and they try to put things like an earnout or making you roll a lot more equity than you should because they're worried about you. So if you really want to exit the business pretty soon after, you need to minimize your role in terms of how important you are. And that's a key thing we do during the process. If we know a founder wants to leave, we minimize their role in the process and have them talk to a lot of the other employees. They're going to fall in love with the founder and then want you to stick around. And if you want to exit, those two things are totally at odds. The other thing I would just caution you against, particularly in early stage of talking to buyers, we had a client do this not too long ago where they were talking to a lot of PE firms and made it very clear that they wanted to leave day one. And buyers not pushing back on that is different than agreeing with that. So you want to be careful about how you frame your role. I think ideally, if you're going to leave the business, you want them to believe that you're going to do a good transition and that the business is in good hands with the current employees. But there's lots of mistakes around this. And again, be careful about saying too much up front because you might think they're agreeing with you when in actuality, they're just listening, but they haven't agreed. And that's a common mistake I see made. So just make sure you're on the lookout for that and have a good strategy for that. The best strategy is to have a strong team below you so the buyers feel comfortable with that. Moving on, we just want to talk a little bit about diligence and financials. I would say this one always comes together last minute, meaning you hire a banker and there's this rush to put the materials together. We have several podcasts around how to frame the business and how to think about the financials and get them in good shape. But Miles, just talk about what would be a best practice for getting this going much earlier before you think about selling your business.
Maybe just to frame up the timeline of some of these different things. So tax and estate planning and succession planning, that's something you should be looking into ideally a year plus in advance of looking at a transaction. The diligence and financials, this is actually probably something that makes sense to really hone in on and focus on, call it like 3 to 6 months before looking to engage with an advisor. And so really what you're trying to do here is minimize the amount of work and the delay that ultimately might take place post hiring an advisor. And there's a couple really key areas where this is done. So buyers and investors, they will have extremely lengthy diligence request lists. And the goal here is not necessarily to get every single thing lined up, but really some of the heavier lift items. And so what does that mean? Generally, financial statements. So ensuring that your financials are very buttoned up, they're being recognized at least close to GAAP, if not entirely in line with GAAP, accrual basis financials as opposed to cash basis. And the same thing is true for the revenue by customer or customer cube. This is, I'd say, right after the financials, probably the second highest diligence item. And it's an area where we spend a ton of time as we think about positioning retention and overall trends in pricing and the customer base. And it's something where, frankly, we do a ton of work because very few companies have this data set in a position where it's ready to be reviewed by buyers and investors. So those are really, I think, maybe the two largest. There's a long tail of other things like ensuring you are tracking and allocating COGS properly. So we see a lot of companies that do not include customer support costs in COGS. And so generally we make some adjustments on our end, but that's something that's really helpful that if you start tracking it early, you can really optimize over time. So that way, before you do pursue a process, you're in the good position.
And one of the reasons why we highlight this so much is amongst founder-led businesses who've not raised a lot of capital, this is the area where they're most behind. And if you think about it, it totally makes sense. So founders don't operate on GAAP accounting. They operate on cash flow, right? So they're worried about making payroll, investing in sales and marketing, how to allocate capital. And GAAP doesn't really help you with that when it comes down to a cash flow situation. A lot of these metrics are more GAAP-based, if you will. And so founders tend to underinvest there. I would say this is the top area where you're opening yourself up to a retrade if you're not buttoned up. So you present your financials and the marketing materials. The buyer is going to hire sophisticated accountants to come look for stuff, right? They're looking for an opportunity to retrade you. And they almost always find something with these businesses when they're not accounted for the right way. The other reason I think it makes sense to do this early is oftentimes when we're digging through the data, particularly on retention, we're looking for a way to frame the business. So we'll find cuts of the data where the retention's amazing and some of the longer tail customers where the retention is not amazing, actually weighing the business down. So oftentimes if you do this work up front, it actually might change how you go to market. And while we can frame around some of that lower retention, the best thing would be not to have it at all because you could invest your resources going after the better clients. So just understanding some of this stuff earlier can actually help you make better decisions in your business. And that should lead to a higher valuation. So I think this is an area you need to spend a lot of time on. And it's the area where our clients are the least prepared and open themselves up the most for a potential retrade if you don't take care of this before the transaction. You can do this before you market, and we do it all the time, but it would be better to do it much earlier. The last item we wanted to talk about is just the banker selection process, assuming you're going to use a banker. So we're going to give you some criteria and how to think about that, how you should select your banker. So Miles, why don't you start us off there?
So I think every bank has their own criteria that they may pitch. And so as a founder, it's just really important to identify upfront what is important to you. And for a lot of founders, that is relevant industry or vertical experience, right? So for our clients, at a minimum, experience with SaaS businesses. And then the plus there would be businesses that have a lot of similar attributes, either in terms of their end market, or maybe it's just different features. So maybe you have some type of integrated payments revenue that you have running through the platform. And so does that advisor have experience positioning similar businesses? Maybe you have a little bit of customer revenue concentration. So finding advisors that have experience positioning that before, and also reoccurring revenue, right? So if you have reoccurring revenue in your business, does that advisor have experience working with businesses that have similar revenue models? And how do they position and frame that? So I think that's probably the most important. But right up there would be transaction size. You don't want to be a bank's largest transaction, and you definitely don't want to be their smallest transaction. So you really want to be somewhere in between in that sweet spot, and just making sure that the bank has experience with businesses of your scale, knows the market, really as it pertains to growth equity firms and strategic buyers looking for other businesses of your scale and transaction size is another really important item. And then I think kind of lastly on this list is just identifying potential conflicts of interest that bank may have. So does that bank constantly represent either strategic buyers or PE or growth equity funds that may own or invest in other strategic buyers in the business? And what does that mean when it comes time for them to negotiate on your behalf? That's just one example. There's a long list of potential conflicts and a lot of nuance there, but I think making sure you really ask a lot of good questions around that is a really important step to make sure that you ultimately aren't disappointed down the road and have any issues.
Absolutely. And I think one of the things founders should do is start to curate that list of bankers a little bit earlier. Oftentimes, they just decide they want to sell and they reach out to a bunch of bankers and run a process to select a banker. I think what you want to do is look at bankers from afar for a while to try and understand what they're doing. What you have to know is all bankers are good at sales and marketing. And so you really want to be able to diligence the things that they're doing. So oftentimes, we'll see books from other banks where they're touting the deal. And we know that was a terrible business with a terrible outcome. So you want to be able to diligence the outcomes, like what were the revenue multiples they got for these deals? The other things you want to look out for is there's a lot of movement within banks. So sometimes you'll have someone who's a really junior banker on a deal, like maybe an associate or an analyst, move to another bank. And next thing you know, they show that tombstone as a deal they did. You generally want to make sure you're talking to the bankers who actually advised on the transactions at that firm. That's usually pretty easy because most bankers want to be in the press release. The firm wants to be in the press release. So really diligence those transactions and press them on the multiples they got for those deals, because sometimes they're just trying to show you a deal that looks similar, but it's either not that similar or frankly not a great outcome. Miles had some great points on transaction size. Like you definitely do not want to be the smallest deal, and really diligence these conflicts of interest and trying to understand where their revenues come from. So I think a really helpful thing to do is to ask them for a breakdown of their revenue by founder-led sell side versus maybe a private equity-backed company that they sold, or did they work for the private equity firms or the strategic buyers? Trying to understand that revenue mix tells you where their interests are and whether they're really working for you or for the buyers. And then the last thing I would just mention, reference checks are really common. I think sometimes founders get bullied into taking the one or two references the banker wants to give them. Every bank has several good references, right? Get lucky on deals. Deals go really well. I find the best thing to do is to ask each banker you're talking to for a list of 15 references. And then obviously you're probably not going to talk to all 15, but pick 2 or 3 of those to talk from. So you're getting a more representative sample of what the relationships look like. And then also be really skeptical of buyer references. If you have fantastic references from the buyers, that may mean you didn't push them that much or gave them a free shot on goal here because of a relationship. But I think judging a banker over a long period of time, talking to them at a high level about deals that are marketing, and then see what happened with those deals, bankers are willing to invest a lot of time up front, obviously, because these clients are valuable. We covered quite a few topics today, but really we just wanted to give you a sense for some of the things you need to start on upfront and early, long before you're thinking about selling a business. We talked about the tax and estate planning, how critical that is, because you may be able to have some real savings if you start earlier. Succession planning, how to keep yourself out of a bind in terms of having to stick around for a long period of time if you don't want to, or roll over a lot of equity or an earnout, which obviously earnouts are the worst. And then we talked a little bit about getting prepped for diligence and financials and how to select a banker. But Miles, thanks for joining us.
Absolutely. It was fun. Thanks.
Vista Point Advisors is a founder-focused investment bank that advises software and internet founders through M&A and capital raise transactions. We are a fully unconflicted investment bank who only works for founders on the sell side, so you know that we're always representing your best interests. Securities offered through Vista Point Advisors, member FINRA, SIPC. This has been provided for informational purposes only. It is not intended to address all circumstances that might arise. Testimonials from past clients may not be representative of the experience of other clients, and there is no guarantee of future performance or success. Clients are not compensated for their comments. If you have any questions about the process of selling your business or raising capital, reach out to a member of our team, or check out the For Founders section of our site by visiting forfounders.guide.